Buying a laundromat can be your ticket to financial freedom. However, being cash businesses, they can be a little bit tricky. And I want to outline the 3 biggest mistakes that I have seen laundromat owners make when buying their first laundromat that has set them back on their journey to financial freedom. And this is based off of over 1,000 consulting calls, plus my own experience, plus just talking to owners all over the country and beyond, collecting their mistakes so that you don't make them. In fact, I'm going to throw in a bonus, number 4 mistake that I've seen people make that might actually be the biggest mistake of all. So make sure you watch to the end. All right, let's jump in with the first big mistake that might just be the trickiest one of all, and that is not properly verifying the income of the laundromat. Now listen, most laundromats still are cash businesses, and cash businesses mean, I'll call it creative bookkeeping, meaning most laundromat owners are either really bad at keeping the books or they don't even keep books at all, or maybe they're really good at keeping the books. Like maybe they have more than one book and it's difficult to know exactly how much money is coming into the laundromat every month. That creates a challenge when we go to verify the income and determine the value of the laundromat. So that begs the question then, how do we verify the income properly of a laundromat? That's where I deploy what I call the income verification stack, or IVS for short. And the income verification stack is basically a method of stacking different verification methods on top of each other in order to determine how much money is coming into the laundromat. This is a method that we utilize in the laundromat playbook. So what are those verification methods, you might ask? Well, let me throw a few of them out for you that you can implement when you're looking at your first laundromat deal. Number 1 is what we call a coin count. And that's basically where you go with the owner to the laundromat on coin collection day, and you go through and collect all the coins with them, count how much money actually came into the laundromat during whatever that collection period was. It could be a few days, it could be a week, it could be longer than that. That should give you an idea of how much money came in during that time period, and you should be able to extrapolate that out or do multiple of those over time to determine how much money came in over a month. Now, that's not foolproof, so we need to stack more methods on top of it. So another method you could utilize is what's called a water analysis. And the water analysis basically uses a mathematical formula to calculate how much money approximately has come into laundromat based on how much water was used. Now, that might sound really complicated, and it is a little bit complicated, but you can go to laundromatresource.com/resources and download a spreadsheet that I created just for you that does all the hard math for you on the water verification method. Another tool you can utilize in the income verification stack is obviously requesting documents. That might be bank statements, tax returns, or any contracts they might have with any clients. Now, the caveat to that is sometimes the owner will just straight up say no and not give you any of those details. And that can be very frustrating, especially if this is your first laundromat and you're trying to figure out how much money is actually coming into this business. On the other hand, they may say yes, but we'll give them to you. However, the bank statements, the taxes, tax returns, they're going to say this amount of money came in, when in reality, this amount of money came in. And usually that number is going to be greater than what's reported on the tax returns or than what you can see in the bank statements. Now, does that mean you should automatically rule out this laundromat? No, not necessarily. This is fairly common in this cash business of laundromats. However, one good rule of thumb that I live by and that I suggest my clients and you live by is if somebody's willing to lie to the federal government about how much money their business is making when there are serious consequences for getting caught, you better believe they're willing to lie to you about how much money their business is making when there's really not very many consequences at all. So just beware and do extra due diligence. Those are a few tried and true methods you can use in your income verification stack when verifying the income of your laundromat. Now, obviously, if this laundromat is a card-based system, you can just request printouts of the reports of how much money came into that business and be pretty confident those reports are going to be fairly accurate. Okay, number 2 big mistake that I see people make is not properly accounting for all expenses. Let me tell a little story. I had a consulting client one time that we were under contract, or they were under contract with a laundromat, and we had done the income verification stack. We were pretty confident how much money was coming in. We had checked out all the expenses. However, a week before the close of escrow, we figured out that there was a sewer bill that wasn't being paid by the laundromat owner. And fortunately, and unfortunately, it was of no fault of the owner. The sewer bill was going to the landlord, and the landlord was not passing that bill along onto the laundromat owners. And it ended up being a $500 a month bill. And that $500 a month bill, obviously that adds up to about $6,000 a year, which is not a small sum of money, but based on current laundromat valuations of about 4 to 5 times the net income, that $6,000 could be worth somewhere between $25,000 and $30,000 of equity. So if my clients had purchased that laundromat at the valuation that we had originally given it before we found this sewer bill, they would have immediately and instantly lost $30,000 of equity in their business. So it's a big deal that you account for all expenses. Now, let me tell you a couple of different places that I've seen this play out most prominently. So number one is a lot of times, and we see this a lot in this business, where an owner will be working in the business. Maybe they're cleaning up some days or all days. Maybe they're working a shift for the wash and fold, and they don't count that time as an expense to the business. However, if you're buying a laundromat, my guess is that your goal is not to work in that business all day, every day. My guess is that you are attracted to this business because you want to be able to have an asset working for you while you're not working there, which means that that time needs to be accounted for when it comes to your expenses. So you actually need to figure out how much is it going to cost you to replace those hours and insert that into the expenses before you do your valuation. One other place I see this egregiously displayed in a lot of laundromats is in the maintenance and repairs line item. Listen, this is an equipment heavy business. Repairing equipment, maintaining equipment, those are just parts of the business. They just come along with the business. And, they do break down. And especially if you're doing good business, a lot of people are using them. And so they do wear out. So you do have to maintain those. And that can be costly. That can be expensive. These machines are not cheap. So it costs some money to keep them up and running. So if you're looking at a line item, unless you have a laundromat that you're looking at that's brand new, if you see a line item for maintenance and repairs that's under about $500, you should just assume that they're underreporting those maintenance and repairs. And if those machines are over about 10 years old, you should see at least about $1,000 a month of repairs, depending on the size of the store, of course. But you can check with the distributor or a service technician to see about how much you can anticipate those costs being for you when you take over. Use those numbers when you're valuing your laundromat. Mistake number 3 is tricky, and I see this catching people up all the time because they skip this step, and it is ignoring the trajectory of the business. Now, trajectory just means the performance of the business over time. And when I say performance, I mean something very specific. I actually mean a specific number. And performance, when we're talking with businesses, especially laundromats, we're talking about net operating income. Okay. And that is your total income minus your expenses, but before loan payments and taxes, things like that. That's your net operating income. And we want to see what that is doing over time. We want to know if the business is going up. We want to know if the business is plateaued and is stagnant, and especially we want to know if the business is going down. And the question we need to ask ourselves, no matter what the answer to that question is why? Why is the business going up? How do we keep that train rolling? That's what we want to continue doing, right? Why is this business stagnant? How do we breathe new life into it and get that business growing again, if necessary? Or, and especially, why is that business declining? And can we level off that decline and get it growing again? Is that an obstacle that we're going to be able to overcome? So besides the net income trajectory, I also recommend looking at the gross income trajectory. How much money's coming in? Has that been going up or down? The gross expenses, has that been going up or going down? That could be labor costs increasing. That could be rent going up. That could be utilities going up, a myriad of things happening or down. And the other thing that's very important to map out is how the utility usage, not the amount that you're paying for your monthly bill, but the actual usage of the utilities. What's that trajectory like? So the electric usage, the water usage, and the gas usage. And usage, you should see those generally going around the same trajectory as the income is going in for your business. Okay, the big number 4 bonus mistake that I see people making all the time is signing on to a bad lease. A lease will make or break your business faster than just about anything else. A lease for a laundromat owner is like a marriage. And if you marry the wrong person, you're in for a lot of suffering, right? But if you marry the right person, listen, your life's just going to be easy. You're going to thrive. It's going to be simple, right? Or maybe not easy per se, but it's going to be so much smoother, right? So the question then becomes, what makes a bad lease versus a good lease? Okay, here's a couple of indicators that can help you determine whether the lease you're looking at for your laundromat is good or bad. Number 1, the rent. We're looking for our rent to be about 25% of the gross income of the laundromat or less. A little bit more than that is okay, but once you start creeping up over 30%, it gets tougher and tougher to make money in the laundromat. I'm not saying it's impossible, but just as a framework and a benchmark, 25% of the gross rent of the gross income is what we're looking at for the rent. Obviously, less than that, even better. The second indicator that you need to look at is how many years are left remaining on the lease. Now, for a good lease, you want at least 15 to 20 years of rent remaining. Now, that doesn't mean you need to have a 15 or 20-year lease per se, but something like a 10-year lease with 1 or 2 or even 3 5-year options to renew that lease will effectively give you that 15, 20, 25 years for a lease. And that is good news for a laundromat that gives us stability over the long term and ensures that as long as we're running a proper business, we're going to continue to make money for a long time in this business. And there are other gotchas that you need to look out for when looking at a lease. We can't go into all of those. Maybe that's a totally separate YouTube video. But here's a couple of gotchas that you can be looking for. You want to make sure the lease is assumable or assignable. You want to look for any exits there are for the landlord and how the landlord could or maybe couldn't manipulate those exits so that you can't just get booted out at the whim of the landlord. And there are other legal gotchas that I recommend you having a lawyer read over the lease to look for as well. Now, listen, this is a high-level overview of the 4 most common mistakes I see people making when they're buying their first laundromat, but there's lots of different pitfalls and ways to go wrong when buying any business, especially a cash business like a laundromat. If you're someone who is looking to get in this business the right way the first time and you don't want to have to reinvent the wheel, check out laundromatresource.com/playbook and see if that is something that's going to fit your needs to help you get into this business the right way the first time and accelerate your path towards financial freedom. If you're looking for how to value a laundromat and know exactly how much it's worth, check out this video right here and we'll see you over there.